The market just notched fresh record highs, but history says September's not done with us yet. We got everybody out celebrating rate cuts, chasing the tech giants, piling into those risk-on trades, trying to get rich overnight. But the second half of September has this reputation for flipping the script. So is this rally the start of something much bigger, or are we staring down at the classic bull trap? Let's see and break it all down. So stocks wrapped up this week at all-time highs completely across the board. The Dow climbed 0.37%, S&P 500 gained 0.49%, and the Nasdaq popped, gaining 0.72% on the day. More importantly, all three indices ended the week with gains of over 1%. That marks the 6th record close for the Dow this year, the 27th for the S&P, and the 28th for the Nasdaq. So if you've been holding stocks, you've been doing pretty well, and that's historic momentum. But as LPL Financial puts it, September has two halves that it divides out into. So September tends to split into those two halves. The first half is usually flat or slightly positive is how it tends to perform on average over history. But the second half on the other end, that's where it gets a little bit different. The market tends to slide into the month end. It's the kind of seasonal pattern that traders just can't ignore, and especially as everybody's trying to be this trader and get rich overnight and be smarter than the other person and make all of these theories and adjustments to their portfolio. Just watch this one. But if stocks are at record highs, are we running too hot? So Mark Hackett over at Nationwide says probably not quite. And we're looking at the investor sentiment survey, and what we're seeing is bullish sentiment sits at 41.7%, which is above average. Bearish sentiment is still higher than usual at 42.4%. And what that tells us is that investors are far from euphoric. It's more like cautious optimism. But CNN's Fear and Greed Index backs this up. It ticked up to 62 this week, putting us in greed territory, but still well short of the extreme levels that often flashes a sell signal to the market. And money flows confirm that. Plenty of cash is still parked in money markets and bonds and these CDs, and that is not the picture of an overstretched bubble, at least yet. Now, of course, the real driver here is the Federal Reserve. Investors are betting that the central bank isn't done cutting yet, and next week Powell will give his first remarks since cutting rates for the first time this year. So markets will be dissecting every word from this man, watching him like a hawk. So this is what the calendar looks like. On Monday, we got some Fed speak. We got John Williams, Alberto Mussolini, Stephen Myron speaking, President Beth Hammock, Richard Fed President Tom Barkin. Monday is going to be packed with a ton of Fed speakers. And then Tuesday, we got Michelle Bowman, PMI, we got Raphael Bostic, we got Jerome Powell's speech. That's the one investors have circled, underlined, and highlighted alone. Then Thursday and Friday, they bring all types of data and then Wednesday, San Francisco, Mary Daly, she speaks. But Thursday and Friday, we got a ton of data. That's where all the data catalysts come in. PMI, jobless claims, GDP revision, the Fed's preferred inflation gauge, PCE, that report will be dropping. So the bottom line that we're going to be watching for is that Powell's tone and where we go with that, paired with Friday's PCE data, which could confirm whether the Fed's pivot toward growth keeps fueling this rally. Now, meanwhile, the consumer keeps showing up. Retail sales last week, or I guess this week, showed an upside. Restaurant spending is climbing. Households are still reaching for discretionary items. And that's giving markets confidence that rate cuts will boost growth rather than just offset weakness. But I guess it depends on what view you're looking at, because retail sales was fueled by the rich people, the rich folk. Everybody else is semi kind of struggling right now, and there's a warning here. Inflation hasn't vanished. It hasn't gone away. It's still there, and if consumer strength reignites price pressures, the Fed's path could get more messy, could look like stagflation, and that's not the coolest setup. But speaking of setup, So, where does this leave us? We got stocks at records, sentiment climbing, but not necessarily euphoric yet. We got to throw the yet in there. And the Fed pivoting to protect growth. History says late September often turns quite bumpy, so to say, but this isn't a typical setup. So, if Powell reassures investors and markets that more cuts are on the way and they're on track to continue seeing cuts, there's fuel for the rally. But if he hesitates, if he changes any of his verbiage, volatility could return quickly, faster than fast. So watch two things next week super closely. Underline, highlight, capitalize, and just stare at it. Friday's PCE inflation report and whether Powell's tone matches market expectations for more cuts, because right now sentiment is fragile. They're watching for any reason to go bullish and continue to be bullish, or for the opposite turn and to become bearish and start hiding in a cave. And markets have very little patience for disappointment, especially as stocks are at these wild valuations. Now, the valuations could be okay, assuming AI continues to drive earnings growth and companies keep getting profits and revenue coming in from consumer spending strong. But if the labor market turns, if Powell's tone starts looking a little unsettling, all of that, like I said, could change very quickly, y'all. Thanks for hanging out with me. Hope your day was great. Hope you enjoy your weekend. I'll be back to talk about what happens Monday, Tuesday, Wednesday, Thursday, and Friday of next week. So if you miss any of the news or the headlines, just tune in here at this channel, watch what's going on with me, and we'll just keep on learning, y'all. Have a good one.